I am muted. I am so sorry. Hey, Matex and Jim, good to see you guys. My name is Levi Woods. This is August 5th. It is, man, my mouth today is not working very well. Drawbridge Finance, August 5th, public live stream. It's Tuesday, which is awesome. It's one of my favorite days of the week. We're getting into what's going on in the market. We're going to take a look. If you've got questions about specific stocks or topics, please let me know. Maybe we can do some options chat today. Like, what is your favorite strategy? What's your go-to? Are you do you do short butterflies? Do you do long iron condors? Do you do covered call strategies or short puts? What is it that you like? Let me know in the comments. I know there's a couple people, they always want to know kind of what's going on, what I'm looking at. It is the summertime, so it's a bit of a complacent time in the market in general. We're going to get into taking a look at what is going on in the markets and some of the stocks that I am watching as of right now. So let's take a look at the market. Rather complacent day, as I said. SPX trading up 0.2% and down 0.2%. NQ down 0.26%. Russell up 0.5%. Dow Jones Industrial flat on the day. VIX at 17.5, down 0.57%. US oil $65 a barrel, down 1.42%. I am really interested in US oil. I'd really like to get into a position, but what I want to do is I want to start a position when we drop down below this 64 mark. That is the idea from what the perspective that I would like to get into. Gold coming up these last couple of days, up today, down up 0.17%, and you can see just riding along this trend line that we have marked on here. You know, this particular trend line that I marked, this blue line, is the higher lows that we're experiencing. So we did break down below that. We've had lots of volume at this level, and I can see some continued upside to both silver and gold as they ride up, metals being very, very strong. SPX, we can see that we did have a little bit of a breakdown last Friday, which was great. This was very much expected. We can't just kind of ride all the way up without little pull downs every once in a while. We see that frequently. We see, 4 or 5 days, and then we see a little pullback. Then we see some rising, and we see a little pullback, and we saw that. So now we are seeing a hammer candle right now on today's price action, a little bit of movement, but this is a bullish momentum candle, and we expect, or I expect, to see us surge back up to all-time highs after we saw this little pullback. NQ, if we take a look, similar sort of thing. We saw lots of trading Friday, long deep candle, recovered that full gap on Monday. Now today, after the Canadian holiday, we're back at our desks today. We're moving back up, and I expect, again, a handle on NQ, or a hammer candle on NQ. We're going to see some upside. Good afternoon, Kevin. Good to see you guys. So thank you so much for joining my chat as per usual. Now Russell has been definitely in a different sort of range. You can see we're not looking at the all-time highs. We're not looking at the upper side of this Bollinger Band. What we're doing is we're just looking at the kind of sideways movement that has occurred since we've recovered from the drawdown earlier this year. Again, I'm super bullish on IWM. I think that we're going to see some more movement to the upside. Dow Jones Industrial Average looking closer to IWM, just from a technical perspective, is still above the VWAP. Everything is above. We are seeing a little bit of bullishness overall. U.S. oil reflecting that sentiment as the market was moving up. The U.S. oil coming down a little bit, and gold kind of moving with it, which has gold's had more of a correlation as of late than it has in the past historically. Apple still trading below its VWAP, so I would be bullish Apple. AMD very much overbought at this point. We're looking at extended rates outside of its range. Point of control over the last few months down at 114. Stocks trading at 177. When I'm building trades on something like AMD, I am looking for a movement into a zone that is lower than the current price. ARK-K will see a similar sort of action, and we've talked about this the last couple of live streams. When we see it outside of the band, what I expect is that it's going to pull back down inside the band, and look at that, it did. That's the expectation. I'm not saying that the value for sure is that they're going to always magnet back up to VWAP. It's just that when they're lower, this tends to be a time where it's more likely to move up than it is to continue with the trend to the downside, especially once it gets outside of the expected range. So what does that mean when we look at a company like Adobe? Times where we saw it outside of the range, that's when we have a pretty significant pullback up to VWAP. And again, when we see it down, we pull back up, down, we're pulling back up. That's kind of how that goes. So when we're inside, it could easily go down, but it's probably not going to go down much further. It's more likely, if I was guessing, which we always are, if I was guessing where the price action was going to be, it would be to the upside. Now, we know that Adobe have taken a look at this, and their fair market value is 480, and I've marked that up here. That's the screen line. So when I see these two things correlating, I see the stock has fair market value up here, 480, and then we're trading down at the bottom of the band. We've got earnings coming up. I could easily see Adobe just push. So we will see what happens, but that is my expectation moving forward. Amazon, VWAP, again, very important. When we're outside of those bands, we expect that the likelihood of the direction is going to be closer to the bottom side than, and likewise when we're down, the action is going to be up. Amazon has come back down to this VWAP. So now the expected move from here looks a little bit more to the downside than the upside, but I would be playing neutral trades on stocks like this. That's the kind of expectation that I have based on the fact that I like when they stay in the band. They often do stay in the band. Baidu has quite a limited range here. It very much has been, look at how compressed this trading action has become. If we zoom in, all of the price action, looking at the volume profile here, has been this core band right here. Like that's where we're seeing the bulk of the trading that's occurring right around VWAP. So a neutral trades on stocks like Baidu, that's kind of what I'm looking for. Or if you want to play a contrarian, this is where you might go long Condor and say, well, there's going to be some sort of move to one side or the other. Chewy has, earlier again, we're just looking based on technical analysis only. When we're way extended, what is the likely direction? Well, it's back down towards the VWAP. This is how cycles work. So when we look at Hood, I hope you guys can guess, we would say, well, the likelihood is down. So when I'm playing a stock like Hood, I'm only looking for trades that have a positive range in this kind of area. I'm not looking for extended upside, even though that is the trend a lot of the cases. Google up near the top of its band. Meta reported earnings last week, came right outside, and you can see that that band just kind of is slowly drifting a little bit wider, but my expectation would be that we would come back closer to the point of control. So I would be putting on slightly bearish positions on a company like Meta. Do you guys have any stocks that you'd like me to take a look at? We'll do some analysis. We'll look at Seeking Alpha. We'll look at Investing Pro. I have links for all of my affiliate links are down below in the description of the video. So if you use those, I get a little kickback. You get the best discount you can possibly get. That is the cool thing about using affiliate links. So whenever you're signing up for anything, you should definitely look at YouTubers like myself, either myself or other people that you're watching, and say, what are the tools they're using? And can I get a really great discount by getting in on using their links? So I would love to know if you've got some stocks that you want me to take a look at. Maytex says, I like the LPLC in the long term versus, okay, so I like, as he's saying, I'm reading the abbreviations here. I like the LP, so I'm assuming long put, long call in the long term versus short put, short call at the moment. What are you currently trading? Well, I trade a combination of things. When volatility gets low, when we look at the VIX level, let's pull up the chart. When the VIX level gets to around this red line, which is marked on here, what I'm doing is I'm typically putting on diagonals. Diagonals are nice because they have long vega, and they still give me positive theta decay in most cases. So that's kind of how I like to function with those stocks or with those positions in general. If I want to play the swing, if I think there's going to be a swing, then definitely doing a combination of long puts or long calls. I think that they're better when we're in low volatility. There's many traders. Like if you watch Tasty Live, they recommend that we reduce our position sizing when we're in low volatility, but we can be in times of low volatility for a very long time. So what I do is I switch gears to trades like the humpback, which is a short put and a call diagonal spread that is combined. And I do that so that I get the massive theta decay from the short put, but I'm also getting a little bit of positive vega and extra theta decay from the diagonal call spread. So that's why I like to use trades like that. We can also use like unicorns, which are like a double call spread, or you could use double diagonals. Then any of those trades they're a little bit more flexible in these time frames. That's kind of what I look at, but I also think that there's time for just spreads in general. When volatility is low, it doesn't necessarily mean we can't play short puts. We just probably should play them with some defined risk. That way, when there's a move to the downside, we can utilize that cash to potentially make more money by defining the width of our spread. I'll give you an example. Like say we took, let's pull something up here. Let's just look at Adobe. I think this is a good example in general. Say you were in a position where you wanted to have a short put position. Stock is $34,000 position. So you have to have a relatively large portfolio to play 100 shares of stock, with keeping in mind that we don't like to have single allocation of any one particular stock of more than 2% in our account. So if I'm gonna have a $34 position, then that 34,000 has to be 2% or less of my portfolio. That's when I might be considering selling a short put. In the case of looking at the positions, sometimes it can benefit us quite a bit by selling a put spread rather than a short put by itself. When we see a down move, one of the adjustments that we can do is we can actually sell off that long put and take off the fact that it is defining our risk and actually just take the profit from that. If we were to look at the options chain after a substantial move, from Adobe moving from 385 down to 330, if somebody had been short, the 350, say had done like a 350, 340 put spread, well, that long put is now tested. It's worth quite a bit of money. If the portfolio warrants it, this is a time where you can easily just sell off that long put and say, okay, well, I've made some profit off of that portion of the trade and turn it more into a swing trade. So you put it on as a spread and convert it to a naked short. That can work extremely well. I see John's online. He says, happy Tuesday. Appreciate that. And let's look at some other tickers. What else do you guys want to look at? And strategies. If there's any strategies you want to talk about, one of the things that I like are right now in low volatility are covered calls. When we look at the market and it is high, like the SPX is right now, these are great times to be playing covered calls. We can look at the out of the money call. All this does is provide protection to the downside. If our portfolio does go down, we're benefiting from that short call. We are already near market highs or near all-time highs, so we can selling an out of the money call allows the value of the portfolio to run up to that before it starts losing money. The other thing I like to do is just build trades below. So I might build butterflies in this area where I think that I might make some money. When we're buying a butterfly and the peak isn't where it is, if we're buying it with the peak, how do I explain that? If we buy it where the peak is, like say I did a peak on SPX at $6,050 when the underlying right now is trading at $6,300. So if I buy a butterfly there, I'm setting myself up for a small loss if the stock index continues to move sideways. But if it moves down, these can be huge winners because the cost of buying an out of the money butterfly to the downside is very, very minimal. So I could do something where I'm spending like $300 to buy a trade that can make up to $3,000. This is like 10x return. And when we're directionally correct, we don't have to be correct very many times to have some serious wins. And had we been doing that up here when we were at 64.30, had someone bought a 61 or a butterfly centered down at 60.50, this move on Friday would have made those butterflies winners. And that's substantial. You know, you can make 10% return pretty easily, and you only need one big drop. So if you're looking for ways to kind of hedge the portfolio and say, well, how do I make some money? I think this market's going to drop. Then buying out of the money butterflies can be very, very smart. Coach Ed said, what are your thoughts on Crowd? Pretty big pullback recently, and I see this as a leader in cybersecurity. And of course, cybersecurity is a massive, massive industry. So CrowdStrike, we're going to take a look at that right now. And let's see if I can type today. No, so far, no good. CrowdStrike, CRWD, we're down 3% today. On the 1 year chart, we're 98%. So anybody that purchased shares a year ago has made 98%. Year to date, it's 28.76%. Nothing to scoff at here. These are CrowdStrike, obviously a big player. We see the valuation right now is not good according to Seeking Alpha. We've got a D- rating. We've got massive gross, massive profitability. Momentum is good. Revisions are good. The quantitative analysis ranked in industry is 10 out of 46 right now. And this is why I like the Seeking Alpha. Not only can I compare different tickers, I can see where this ranks from quantitative rating, which is amazing. CrowdStrike doesn't pay a dividend. So these are the type of stocks that what I want is I either want to hold them for long-term growth. So I'm going to buy and hold, or I want to play some sort of position that makes me some money over time. And what I can do with that is I can look at the options chain and say, if we're looking at this, the valuation is a D, but we've got good growth. It's already come down off the highs. Let's look at just this last month. We were trading at July 9th. We were trading at $513. Now we're at $440. So this is quite a reduction from those levels. If we look at the earnings here, we're just going to take a look. So the announcement date was already passed. It was June 3rd. And we're going to look back at the chart here because that didn't show us there. We'll go to the 6-month chart, and June 3rd, that was the earnings date where the stock was trading at 488. We saw some upward momentum since then and now down a little bit. When I'm looking for cash flow plays, what I'm typically looking at is this type of stock where it's coming down near the bottom of its range. I'm going out and saying, today is August 8th. What if I went out to September 5th? What kind of strikes can I build off of this? These are the calls. Let's go to the straddle view, and we can say, here's the indicator. We're at 440 is the current price. And what if I was to do some sort of spread down, at 400 level or 380 level? I'm getting $6 just for selling that put, which is amazing for a $380 stock. That is 1.5% return in 30 days if the stock stays above $380 a share. Now, what I can do to define the risk is I can just go down here and say, well, what if I want to risk, $1,500 minus the credit received from selling the spread? So if I was to, let me just undo that and do that in a different color. What if I was to buy the 365 put for 243 while I simultaneously sell the 380 put for $6? What this gives me is a net credit of more than $3. So I get about $350 for entering this trade. And as long as the stock stays above 380, I get to keep that whole amount of money. Now, the max loss on this is going to be $1,500 debit minus the credit collected. So I'm going to be about $1,200. That's about a 33% return on capital. Pretty awesome for a stock that is fairly unlikely to go down to 380. What we can do is if we look at more sophisticated software, let me just pull one up here. Just give me a second. I'll log into ORATS here, and we'll pull up that spread. You know, that's the kind of easy way to look at it, and then we can do a little more complex analysis if we have better tools at our disposal. What I've shown you so far is completely free to do. You can go to Yahoo Finance, you can go to Google Finance, and you can look at the options chain anywhere, any brokerage. You can see that, and we can do that math. What if I sold the 380? What if I bought the 365? But in this case, what I'm going to do is I'm going to look for a little more specific, result. Like what is the probability that I'm going to make those? So I'm just logging into my ORATS, which is options research, and what's it even stand for? I always forget. It's a great little website. I'll pull it up here in a second for you. Just give me one moment. And then we'll take a look at, so there we go. Let's go into this. So this is ORATS, ORATS, and great little website. So say I wanted to go to Adobe. That's what we're talking about. We were talking about CrowdStrike. Let's look at CrowdStrike. Let me see if I can type 441. And what I can do is I can go to the options chain. And this is really cool because it shows me like the implied volatility of each of the dates. We can see August 8th, 15th, 22nd. The one I was looking at was the September 5th. And what do we have here? Earnings coming up. Next earnings, August 27th. So we do have earnings coming up, and that's where there is heightened volatility, and we can see that visually. And this is why subscriptions to services like ORATS can help us immensely with our option trading. Because we can see the earnings indicator here, but we can also see it visually in the skew of whether or not there's higher IV or not based on those strikes. So let's go out and just look at that September 5th. And typically, if I am going to play earnings, I do it a little bit closer to the date. But if I want to do this, I can at any time. So let's turn this off so you guys can see. What I was talking about doing was selling the 380. And so I've clicked on the chain, and it automatically comes up with what's happening here. So new trade, crowd short put. We're selling the crowd September 5th. 32 days to expiration, 380 put, we're collecting 557. What that does is it shows me what my probability of profit here. Shows me that I'm at 88% probability of profit. It shows me that my break even is 374. The risk to reward is relatively low, 1.16 to 2. Max gain $566. Max loss in this chart, just in this chart, 9,116. Now, this is a $44,000 trade. If CrowdStrike went bankrupt and the stock went to zero, my max loss could be $44,000 minus whatever I collect. So about $43,500. So considerable risk on this. And we can see that when we look at the chart. So even though it's an 88% probability of profit, we can see, wow, this is a big steep, lots of risk for a small amount of reward. These are highly probable trades. I mean, 88% probability. Worst case scenario, we're rolling a short put. We're in higher IV than we currently are, and we're getting a credit to do so in most cases. But what I would like to do with this is consider buying this spread and saying, well, what if I bought some of that off? Now my max loss is considerably smaller. When we look at this, the whole slope is changed. A max loss is now $1,220. Max gain $278. That's a risk reward of 1 to 4.5. So that's pretty good. 86% probability of profit. And we can just look at this chart. Like the green looks bigger visually than the red, which is nice. I don't want too skinny of a little potential profit. The other cool thing about this is like what happens if the IV changes. So we can actually see what if IV decreases or the days to expiration decrease. What does this look like? And it will chart this out for us. And then we can say, well, what if the volatility changes or goes down over the course of time? Well, just the volatility decrease, you can see that purple line there. this becomes a winning trade quite quickly if the volatility decreases. But what if the volatility increases? How does that chart out? You're going to see that this is going to change this so that if there's it'll refresh automatically, but it will show that this purple line will go lower, will actually not be in as good a spot. Now we can protect these trades a little bit. We can do that. We can kind of buy some protection, and it can work quite well. I don't love buying protection using diagonals or calendars when earnings are coming up. I don't like to do that type of thing. So we can buy puts, which is one form of protection. We can buy put spreads as well. So there's always that choice. Like this particular trade can make $190. Well, I can easily go in here and I can buy a little spread or portion of a spread. And let's see, can I do it here with this wide? Probably not. But if I had about $1,500 in risk that I'm willing to take, so in this case, max loss of around $1,100. Let's see if I can widen that spread out by turning this into a bit of a ratio and building a butterfly. So if I sold 2 of the 380s and I bought the 385, what that's going to do is it's going to give me a higher initial credit, and then I am purchasing the 365. This is showing as showing that the purchasing is going to be less than the selling, which is impossible. So this is something slightly amiss with this. Likely I'm going to be paying $720 and then selling this for $555. So my debit will be considerably smaller. This needs to refresh. And again, we'll just wait a second while it does that. And I'll read some comments and we'll take a look at what people are talking about. So Brian 2407 says, I try to earn about 12 to 15% annualized, including the interest earned from the cash secured portion. When we're talking about cash secured, I think that's a very good target. It is. I traded short puts and covered calls for a very long time with that kind of target in mind, that 12% to 15%. I have changed a little bit in knowing that when we look at a short put, the maximum we can make, let's just say we're trying to take the safest trades possible. So we've got an 86 or 85% probability of profit. We're looking at 1% every single month, plus whatever interest we're getting. We can have this can work very, very well. When we're in a bullish market, however, we end up having a run up that is greater than the return of our portfolio. So if we were to compare to like an all SPY portfolio, the SPY may return like 20% like it did last year. And in that case, what'll happen is that we will get, we'll make our 12% because SPY made 20%. That's all great. The problem is in the bearish years. When SPY drops, our portfolio tends to drop as well. And I have to balance like how much I'm capping relative to how much I'm making. So I'm actually have switched over the last couple of years, and I am targeting greater returns than that 12 to 15% for cash secured puts. I am currently targeting anywhere between 50 and 100% return, which seems ludicrous. You're like, okay, if you do that, if you take 50% potential and try to make that every single year, then you're going to miss. First of all, you're not going to make the 50 or 100%. But when there's a downturn, you're going to have a relatively big downturn because you've taken on this lots of risk. But I think that it's a numbers game. When we look at the market, which has been drifting up for many, many years, can I make 40% a year for a couple of years, even if I have a larger drawdown? As long as I'm targeting bigger percentages, I can actually outperform. And if I'm going to take the route of being an options trader, where I want to take on a certain amount of defined risk or undefined risk, and I'm looking at it from the perspective of my portfolio, in my personal experience, I actually have benefited from targeting for these higher returns. In my RSP account, which is a very simplified strategy, I cannot do anything other than covered calls in it. So I'm buying shares, selling covered calls. I could easily deploy that 1%. That would mean that over the last year, when the S&P 500, let's take a look at what the S&P 500 is up right now. We will where are we going to look at this? Let's just look at Investing Pro. It'll tell us here pretty easily. Let's look at SPY. So SPY pays a small dividend, and it pays a dividend of 1%. And Investing Pro, why do you not have a year to date? Why do you not? 1 year. Let's look at the 1 year chart. We'll just go for 1 year. So we have a dividend of 1% and then a 1 year return of 23%. So that's the total 24% return for somebody that's just buying and holding as of last August 5th, which was a down day. I don't know if you guys remember, last August 5th was actually kind of a terrible day, but we're up 23% from that. If I was covered call writing and I was only collecting 1% a month or 12% a year, I would be half what the return is. At this point in time, my 1 year return, where's my phone? My 1 year return in my RSP, let me see if I can pull it up here to show you. Doing just covered calls. See what is on here. No, I can't actually show you this very easily. Sorry. Oh yeah. Yeah, I can. So here, I'll just show you this. Let me make sure there's no personal information on here. This is my RSP. You guys can see this. This is the Interactive Brokers. So holding, we could have had 24% just buying SPY, but there's my RSP right now. Total return last year, 26.42%. Those are real numbers, and the drawdown is pretty significant. Like I'm not gonna sugarcoat it here. You can see I actually went down to negative from last year, but that is a real return, and that is targeting higher percentage. If I was only targeting 12% or 15%, that's where I would be sitting. But by targeting higher, by targeting like 40%, 50%, 100% using covered calls, I can actually make a better return. I could outperform the S&P 500 on a bullish year, which means that I grow my account faster. So, you look at it from a perspective of like, oh, you don't want to take too much risk, but it's like you're actually taking risk by not making money. It's one of the things that I think is harder. As I get older, I look at risk in a different way. I'm like, if I had taken more risk when I was younger, I actually have a bigger account, which, your accounts get to a certain size anyways, and then it doesn't matter so much. We want to reduce risk when we're older. So we have to kind of take that into consideration. But should we be constantly like capping ourselves at a 12% return? I used to do it. And I feel like when the markets went against us, it hurt. And boy, it hurts a lot less when I've had a bigger return and even outperformed the S&P 500. So Coach Z says, I like that put credit spread as well. Thanks for your insight. Absolutely. That's what we're doing. We're looking at things and saying, what can we do? How can we make money off these? That's why I do these live streams, and we can look at the numbers together. And I want to pull up. I just want to see if the odds, if it fixed that. Yeah, it did. Okay, so let's go back to this little butterfly now. This is a $3 credit to, we're paying, price. Spreads are a little bit wide here, but we're getting some sort of credit. Which is substantial compared to the amount of risk that we're taking. And this butterfly, when we look at it, it's huge. It's like the potential profit, the max gain is $782. I could actually make more than I have risked. I can make 100% return on this. Now, very unlikely, and I'm not trying to get that. That's not the idea with these. But what I'm trying to do is create a situation that says, hey, where can I make a decent return on capital? If I can then open this trade for $282 and I have a total risk of $718, That's a huge return. There's an 88% probability of making 33% return on capital. Now, I don't go all in on these, but if I can layer these into my account, if I can take that money and say, okay, I'm allocating a percentage of my account, say 20% maybe that's like a good number to say, I'm going to take, 50% of my account, I'm going to play options. And then of that 50%, a very small portion of it, we're going to play with limited loss trades. But the limited loss trades have the ability to make a lot of money. They also have the ability to lose that money quite quickly. So spreads can be detrimental if we over leverage. Leverage is a killer. So we have to say, okay, how much money do we want to make? We're going to make theta decay. We have a good return. It might be very, very smart to put in these little $500 trades, and butterflies can do that. They have a built-in bearish position when we do a butterfly. That's what's happening. We're buying in a $500 put spread, a put debit spread, and that's what happens when we create that. It creates a profit tent that is quite excellent, and a little bit slower if the market does die off. When we see this increase, what if IV changes 15 days in? It's still a loss, but it's slower. We're not getting to that $500. Even if it was to drop to 280, I mean, we're still not at that max loss right away when there's 15 days left. Okay, let's get into some other questions, and then we will continue from there. We haven't covered a lot of stocks today. What other stocks would you like to learn or talk about? Got 15, I got 4 likes. You guys are awesome. Thank you very much. I know we don't have a lot of viewers, which gives you guys opportunity to ask really specific questions. So don't be shy. I would love to do some analysis of some actual positions. What was a recent trade you put on? I can pull it up in ORATS and we can do an analysis of it. We can take a look and see what the probability outcome is. ORATS is pretty cool because it actually shows the distribution curve of this trade. If we look, it's a little bit, I feel like it's hard to see in the stream, but you can see these, 1%, 1%, 3.9%. Like, it shows the probability of where this may occur. And what we can do with this is we can layer multiple trades on. This is only a 3-legged trade. What if I wanted to, sell a put on CrowdStrike? Let's just clear this off altogether. What if I looked at the options chain for September 5th? And again, this is earnings. And I was looking at that 680 and I thought, you know what? 380, the 380 short put. What if I thought it wasn't going to go above there and I was going to just sell this and collect $555? Immediately selling that put, I have a high probability trade, but it's very low return, $570 max. And the max loss is huge, as we said, could be put up to $44,000. Really easy to defend this trade in general. But what I could do is I could look at this chart and say, you know what, there's a high probability that it's going to stay just in this range. So where is that? Like, this is between 412 and 470. What if I built like a butterfly around that? What if I was to buy in and say, I want to buy the 415, and then where was the top edge here? 475. So I'm going to buy both of those. So we're 475, 415. That's 60 points wide. So we pick the middle of that and we sell. So now we've got a 60-foot wide long strangle, so to speak. It's not really a strangle because it's at both puts, but 30 points above 415 is 445. So what if I sold the 445 twice? And remember, I'm doing this on top of buying or selling my short 480. So I'm going to sell one of these. I'm going to do this for net credit. This is a net credit of $28. So now if it stays above $28, I have the potential of making only $28. I still have a very high probability of making money, 81%. But what have I done here? I have increased my max gain from $500 to $3,000. My max loss is nearly identical. If it goes down, I've moved my break even over by $5. But what I'm banking on is the fact that it could easily stay in this range. Buying a butterfly like that gives me some potential. And if it goes up, I'm not losing any money. The other thing we can do with these is we can build them as broken wings. So we can change those numbers a little bit easily. Like all I have to do is buy the, let's set this up. So we had the 415, 475, 445. Let's clear this off again and let's just rebuild. We'll go back to 380. So we're going to sell that 380. We're collecting 560. Well, what if I bought a slightly narrower butterfly? What if I just did the 425 and then the 445s, which we said before, and then the 475? And if I sell two of these, 445, sell one of the 380s. Now, this is costing me a debit, and it is changing that profit profile. Even though it's a debit to enter, it's kind of wild what it's doing. It is actually showing me that this is my range. If I was in here, I've got 57% probability of profit because I have a small potential loss if the market goes up, right? If it goes to 470, if the stock goes screaming upwards again, then I can go into a loss zone. But this loss is super minimal. You know, and if that was to happen, the IV would decrease. So this is where you get to play with the sliders. You say, well, what if the IV decreases and the stock goes up after, 29 days? And we can see what this profit curve looks like. It actually is still positive. That's that theoretical curve here. So interesting to play with this and say, how can we make potentially more money? Because what we've done there is we still have a max gain of up to $2,700, and the max loss hasn't really increased. But because we're getting into a situation where we could make a little more money in here. Theoretical expiration, if we just go right to 0 here, it'll show us. Theoretical today at expiration, $698 in this whole range. Like this is a very, very solid trade, even though it's being opened for a debit. We have to understand kind of how it works. Buying that butterfly gives us a long put position, a long put spread that we own. So it's pretty cool to play with stuff. What do you guys think of that? Qualcomm, yeah, absolutely. Qualcomm. I always say Qualicum for some reason. I don't know why I jump into that. I add like an extra letter that isn't actually there. Let's take a look at Qualcomm. And then looking to sell puts on it that expire before next earnings. Not sure if tariff risk at this time, but that could tank the stock price prior to earnings if some new announcement comes out. Absolutely. I mean, anything that has physical goods has potential. Fair market value on investing.com is marking at 182, upside of 24%. And again, this is where I like to use multiple services to say, where am I, what am I looking at? So management's been aggressively buying back shares. A high shareholder yield has raised its dividend for 22 consecutive years, and analysts have revised their earnings. So these are all bullish momentum indicators. If we look at the dividend, we've got a dividend yield of only 2.4%. And then from the earnings perspective, we've got next earnings coming out. We had July 30th, and then November, we surprise earnings by 2.5%. And then the announcement date is November 5th for the next one. So we've got quite a ways before the next earnings. So let's go to ORATs and see if we can build something on here. So I'm just going to pull up Qualcomm, and we will take a look at the chain and close this for a second. So again, going out, like what if we were to go out September, 46 days, stocks trading at 147. We saw that fair market value being above. Let's also take a look at the stock chart just on TradingView here, so we can see where we've been and where this potential range is. So looking at Qualcomm, these are the dailies. Been quite restricted movement actually. So going back to last June, we had a high of around 230. We obviously, on tariff news in April, we saw it drop down to 121. We're at the lower part of this band. Point of control is above the current value. So this is where the earnings have just occurred. If I was to look out at September 15th, or I think it was the 15th we were looking at, and I was to put in a vertical line here to say, where's my target? Well, my target zone is going to be right around here from a visual perspective. That's where I'm going to look. Well, that's what my expectation is. So now all I have to do is just read the numbers. This is 178, and then there's 137. So let's go out to ORATs, and then on that date, September 19th, the 140, how much can we get? And let me just turn myself off for here for a second. Well, we can get 279 for that short put. That's a 2% return on capital, on total risk capital, right? So the total risk capital in this case is $14,700, and so that we can get that right here. That's the cost to buy 100 shares. So we just moved the decimal place over. So $14,700. And by selling the 140, we're reducing that even further. We're now doing 14,000 minus the credit received. So around $13,700. And again, this is what I want to look at is, where do I think this stock is going to go? Now that fair market value on investing, .com Pro, we saw overview that fair market value 182. That's outside of the range on TradingView. So it's way up here. So that's another target that I might put on my chart and say, okay, here we go. This is where that stock could easily go to. Got a dividend coming up that's a little bit irrelevant. What I'm looking at is point of control. VWAP and point of control are the same thing right now, this white line and where the blue line are. So, and we're seeing that even on a very short duration. We're seeing that around that 159. So that's where I would look and say, can I buy a butterfly around that 159? Pretty easy to do. Let's do it on the call side this time. What if I wanted to center a butterfly around the 160 level? So I can buy, let's buy 150 and then sell the 160 and then buy the 170. Now this is going to cost me a debit to do this. I'm going to change this to 2. So I'm buying a debit call spread and I'm selling a credit call spread, and they overlap and they create a butterfly. I'm still collecting a credit of 76 cents. So now I have a 76-cent credit. I have no upside risk whatsoever. If I do, let's just say the stock stays above 140. Let's say that it does. So we're at $147 right now. How much money am I making? Well, let's get my calculator out and take a look at what that works out to. So what did we say? 76 bucks? What's the credit? Credit $76. And so we're going to base this $76 divided, and we're just going to do really basic 140 or $14,000. So what's my return on total cash secured value? That's 0.5%. So about 6% annually, a little bit less than around 5% annually. But the crazy thing about this is that by buying that butterfly, if I hold this out to expiration, where did ORATs go? Sorry. What I've done is I've given myself a max potential gain of $1,000. This huge profit tent in here. Pretty awesome. And I can do that. I can move that butterfly wherever I want, basically. I can buy that butterfly. I could even buy 2 of them. I can get really, really sneaky here. And I could buy one below the current price. So, you get into a multiple leg situation, but that is something we could do. We could buy a call spread, or we could buy a put butterfly below. You don't even have to do it together. You can just build it wherever you want. So I can move this butterfly over, and I could have it below my short put even if I wanted. This would give me my 5% return, and if the market went down, it would be moving towards my butterfly. The butterfly would become a hedge below the short put. But 140 is way down here. That's where the short put is. So we have a 69% probability of making money on this, and that 69% of making at least 5% return. but up to 1,000. A 1,000% return or a $1,000 return on 14,000 is considerable. So let's just quickly do that math. Let's just say if we did max profit, which is really unlikely, but what's the maximum potential? 1,000 divided by 14,000 is 7%. And that's in 46 days. So that is a massive annualized return. Those are nice little trades that I like to do. Brian says, I could either sell puts in non-registered account or sell in the money covered call in RSP. Similar profit profiles. Absolutely. Those are the same trade. I mean, the extrinsic value is the same. If it wasn't the same, there would be an arbitrage situation, and the brokerages don't like us to have arbitrage. They don't want us to just have free money, so they don't allow it to happen. That is definitely something that we can do. Sell the in the money covered call, sell sell the short put. What was I going to say about that? For ORATs, we're looking at ORATs specifically, and like what strike we're looking at. Typically, we want to look at. There's two ways that we often look at these. So on a 46-day, I want to make at least 1%. We talked about that, and I am playing things much more aggressively as I kind of stated, but from a price perspective, it's very easy to see if we can collect 174 on a 135 strike, then that's more than 1%. But this is in 46 days. So the 286, 140, that's the strike that I would be looking at to make sure that I'm getting that little bit more aggressive. Because in all likelihood, not in all likelihood, there's a 50% chance from right now that the stock could go up or the stock could go down. That's why I take the more aggressive, because by playing too low a delta trade, higher probability, less cash flow, still tons of risk. I want to make money every single month. I don't mind defending a trade, especially on a good company. Say it goes down, IV increases, I'm rolling that short put. Well, I'm getting a credit. I'm getting a credit every time I roll that short put. Be pretty awesome. Okay, my time is up. You guys are fantastic. I love what we're doing here. Let's get rich together. That's what we're trying to do. So hopefully you guys found that informative. For my patrons, obviously, I will see you guys on Thursday. I didn't even tell everybody. I am officially not a farmer anymore. My dad passed away a couple of years ago, which I know many people know. I inherited the caretaking for the family farm, which includes like haying and all of that stuff. I sold 2 tractors this week, and I no longer own a tractor. We still own the farm for another 10 days, but the farm has been sold. Cleanup has been done. It is looking spectacular. I am ready for my life to get back to normal. And what is normal for me? That is like traveling a ton. So I haven't even told everybody. I'm going to be in New York City on 14th to 17th. So if anybody is out there, I'm going to be staying downtown. We're going to be doing some fun things. You're going to see some videos of me traveling and doing some awesome financial things. We're going to financial district. It's going to be pretty cool. I'm very, very excited about it. I have more details to come, but for now, know that I'm going to be there. And if you are in the area and you want to get together for a beer, I do love drinking beer. I am going to have some flexible time. And would love to get together and chat options in person with any of you. So let me know who's around, and I hope to see you all there. Thank you so much. Let's get rich together, everybody. Take care. Bye.